Hi, good afternoon, everyone. This is David Brown. I'm the Chicago office managing partner with Nixon Peabody, and I'm here with several excellent panelists. I think you'll find our program very interesting today. We've got John Chalice, a director with BMO Financial Group, Brett Holcomb, principal with Prospect Partners, Jeff McNamara, director of industrials M&A with Duff & Phelps, and my colleagues Sam Kim and Dan Stralka. And I'll let everybody introduce themselves in a little bit more detail as we move forward. But very briefly, we appreciate everyone making time for this. I personally am, in addition to our office managing partner, I am our corporate lawyer focusing on M&A transactions, other corporate transactions and deal making, joint ventures, and so on. And the last 6 months have been a truly unprecedented and bizarre environment for deal making. This is part of our ongoing series, NP Impact on Recovery, on what we and many others are doing to get deals done, to get things moving in the right direction during this strange time. This presentation is going to be a little different than many. I'm sure you've watched or presented on others, seen others that are full slides and charts. This is not how this will work. This is more of an interactive presentation, but in the form of a discussion, just getting some of the leading voices, specifically in Chicago for today's program, to talk about what they're doing. Quick reminder that the program is being recorded, and if you've got questions, feel free to submit them through the chat if you haven't already. We've gotten numerous questions from registered guests earlier in the day and yesterday as well. We'll try to get to as many of those as possible. We won't be able to get to all of them, but there certainly is an opportunity to speak to anybody on the webinar afterwards if you have questions. So with that, I'm going to turn to Sam and Jeff for the first part of our discussion. Sam, Jeff, take it away.
Yeah, thanks, Dave. Good afternoon, everyone. Thanks for joining. Sam Kim, Senior Associate here in the Corporate Department of Nixon Peabody. I sit in the Chicago office as well. Like Dave, I'm a corporate M&A, JV Equity Invest attorney, and living and breathing the very interesting times we're in. Jeff, maybe before we get into it, I'll give you a minute to introduce yourself, and then we'll cover some ground.
Sure. Thanks, Sam. I'm Jeff Mackner. I'm a director within the M&A practice at Duff & Phelps. And for those of you that aren't familiar with our firm, we're a global provider of investment banking and financial advisory services with approximately 4,000 professionals worldwide. I'm based in our Chicago office and spend my time as part of our M&A practice really working with business owners, both family and founder-owned as well as private equity-owned companies as they explore liquidity options, mostly through the sale of the company. I also work with clients as a buy-side advisor along with capital raising in the private market. So it's a broad practice with a global reach, but really focused on the middle market. So it's great to participate in today's discussion, and thank you to everyone at Nixon Peabody for hosting.
Thanks, Dave. So, Jeff, back when we were originally putting this panel together, I think we were in a world a few months back where largely all the deals had been put on the shelf. And we were, I think, both scratching our head, frankly, as to what we talk about today, because would it be, how do you diligence and clean house while you wait for the M&A market to return, and what are the canaries in the mine to look for when, the return of deal flow? But I, and I think many others, have been pleasantly surprised with the velocity of which the deal flow has picked up and this sort of recovery. So maybe we'll just start generally with your thoughts on, the landscape of M&A today, what you're seeing and where we are.
Yeah, you bet. And you're right. It has been interesting exchanging different points of view and perspectives over the last few months. There's no doubt about that. But really, the M&A environment here in the U.S. has certainly started to rebound. There were green shoots of activity that we saw really emerging in the midsummer for healthy M&A processes. And that's separate from distressed or restructuring situations. And the activity has continued to gain momentum from my perspective, albeit not all industry sectors are rebounding at the same pace. Restaurants and retail, for example, are two industry sectors that were directly and immediately impacted by the pandemic and really continue to operate under a shadow of uncertainty. But on the opposite end of the spectrum, we've seen the technology sector, as an example, continue to perform well and attract capital. So deal flow continues to recover, but it's industry specific and really more at a granular level, it's company specific. But what's really interesting and unique about the economic cycle that we're experiencing right now is that the economy was quite strong before the COVID-related crisis hit. And from an M&A perspective, the market was fairly robust, driven by persistently low interest rates and record amounts of dry powder that continued to fuel transaction activity. And for large corporations, M&A has and continues to serve as a key area of strategic focus to help drive growth, particularly as companies sit on elevated levels of cash. Companies within the S&P 500, as just an example, are sitting on approximately $3 trillion of cash. And you combine that with the private equity industry that has accumulated over $1 trillion of dry powder, there's certainly a lot of pressure to deploy capital. And it existed before the pandemic and remains there today. But as I mentioned, it's industry and in many ways company specific. And there's certainly governors as it relates to M&A activity. And one governor that continues to remain is how lenders perceive risk and the level of caution that they're taking as they underwrite new opportunities. So it's a dynamic environment, but has certainly improved and continues to improve as we move into the fall.
Yeah. Thanks, Jeff. And we'll wait with bated breath as we see how the next few months unfold. I think to use a trite term, there's a new normal, things are different, right? And deal flow is, I think by many accounts, getting close to, if not exceeded, even in some areas, pre-COVID levels. But what in your mind are some of the differences now that, have fundamentally changed in the M&A landscape? Obviously, where many are not back in person, and that's added a layer, but there are other factors as well. So if you could share your thoughts on that.
Yeah, it's an interesting question. And as you think about social distancing and travel restrictions, it has certainly thrown a curveball to the deal-making environment. But generally speaking, though, the sale process of a company and the steps that you go through are fairly similar in the post-COVID environment, or at least kind of post-lockdown, at least in terms of what we've seen so far. There's a level of flexibility, though, that's needed in a sale process, and the overall timeline may need to get extended as buyers work through their diligence on a largely remote basis. But at the same time, we've also seen, and our team has been talking about some of the efficiencies that have been gained as certain in-person meetings that once required travel have now shifted to video conference. So there are some benefits that we're also seeing, particularly as you think about how management teams spend their time going through an M&A process. But there's also a certain degree of flexibility needed on structuring a transaction to really accommodate the concerns that buyers might have as we continue to emerge through the COVID pandemic. It still remains a bit unclear what the economic recovery will look like. I think we're all optimistic in many ways that the economy recovers meaningfully through the remainder of this year and into next year, but there's still a degree of uncertainty. And we have clients in certain industries that are struggling to forecast financial performance over the next 12 to 18 months. Business might be doing well, they just don't have a lot of conviction in terms of forecasting what that demand might look like. And even if the management team does have that conviction and visibility in its forecast, buyers certainly remain cautious. So to help bridge that divide, particularly on valuation, we've seen earnout structures emerge, and I think it's a creative solution. There's often a negotiation or a lot of negotiation that goes into structuring the earnout, but it has been a useful tool to help bridge that gap between seller optimism and the inherent level of caution that buyers have, not really knowing what the next 6, 12, 18 months really have in store. So we certainly are operating under an environment that has uncertainty, but there are ways to kind of structure around that, and an earnout is certainly one of those that we're seeing.
Yeah, and I would absolutely echo that. I think the number of earnouts I've seen in my deals recently is, and it's in fact in some processes become a way to distinguish buyers in terms of how much of the purchase price they want to have tied up in an earnout and what are the sort of structures that they put in place around that. And it's a way for some buyers to come and distinguish themselves from others. So yeah, definitely echo that on all accounts. So I think our last question will be here is, before we turn it over to others, is so we have a lot of buyers and I suspect sellers on the call today, just given the title of our presentation. And so maybe if you could share just some of your parting thoughts to those who, maybe it's a seller who was looking to sell and, okay, COVID hit, I put it on the shelf, or a buyer in sort of the same position, or one who's now, they're looking to re-engage in the market, seeing, the velocity at which they've resumed activity. So perhaps you could sort of share some thoughts to each of those constituents.
Yeah, you bet. And it has certainly been dynamic. Coming into the COVID lockdown, we had a lot of activity in our pipeline, and the momentum coming out of 2019 was really strong. A number of those processes went on hold. Some of them have re-entered the market. Others remain in a bit of a holding pattern, to my earlier point on management teams wanting to kind of wait and see and get a little bit more visibility. I think it's important, though, to be mindful of how the company performed through the COVID lockdown. Clients have often been asking us if a buyer will give them credit and essentially adjust out on a pro forma basis any negative financial impact that might have occurred through the lockdown. And the answer is tricky because I guess it's maybe in many ways, but it's highly company specific and situation specific. But more importantly, there's nothing that will really prevent another future lockdown. The risk may be low, but it's certainly there. So an investor will be very reluctant to simply adjust out the negative effects of COVID this year when looking at a company's performance. So if your business was materially impacted this year, albeit even for a short period of time, it may be wise to wait until we're further removed from that lockdown period. It also gives you time as a business owner to gain more visibility and see how your company continues to perform relative to your budgeted expectations as we wrap up this year and move into next year. But I would also keep my ear to the ground from an M&A perspective and be mindful of the activity that's occurring in your sector. Going back to my earlier comment on dry powder and the need for investors to deploy capital, if there's an active buyer in your sector and a scarcity of acquisition targets or candidates, maybe having a one-off targeted conversation could lead to a sale before ultimately launching a broad process. And some of the concerns that I outlined may go away if you have an aggressive strategic buyer. So it's certainly situational and company specific, but there are reasons why some businesses have and continue to wait until they're a bit more distanced from the COVID lockdown period. And then there are others that were not terribly impacted through COVID and have already kind of re-entered the market and are going through sale processes as we speak. So it's very situational.
Yeah, if I can weigh in a little bit, I agree, Jeff. And in the lender context, which I bring a little bit of a different perspective to it, I would echo that sort of short-term revenue visibility, along with as much information as you can provide on how the company's performed throughout the pandemic and the projections coming out of it. Is going to be very important for the lender to determine whether they're going to allow any, for example, any EBITDA adjustments when you're interpreting financial covenants or something like that based on the COVID disruption. So, what I found is that based on the industry and based on how much specificity you can provide in a lending context to the lender, the same applies that, the answer is maybe that you're going to get some EBITDA adjustments. But obviously the more honed in you can be and the better information you have, the more likely it is to be successful.
If I can jump in for 1 sec there, I couldn't agree more, Dan. I think that's something that we've seen. We're in the process of trying to close an investment the next few weeks. We've been out to the lending community, and that has been echoed by almost every lender we've talked to, which is they want to base their decisions on a rock solid EBITDA. They will base leverage levels off that. They're not terribly certain that this has all come to an end, so they're a little reluctant to provide credit for kind of COVID-related add backs. But if they are going to provide credit, they want to see as much detail in as short of a window as they can. So don't tell me what happened 2 months ago. Don't tell me what happened a month ago. I want to know how's the company performing today. yesterday, a week ago, 2 weeks ago. So it's a lot more data, and it's, not as far rear view mirror focus. It's a lot more on how we perform right now.
And even when they're allowing some of these deviations or add backs or exceptions to representations and warranties, what I'm seeing consistently is, again, I'm switching to more of a lender role, but when the lenders do allow it, they're limiting, for example, if they want to carve out from the material adverse effect, representation or borrowing condition, they'll allow for anything that's been disclosed up till the date of closing. And then they're almost sort of resetting what your rep would normally be by going back to the audit as to the date of closing with respect to the COVID disruption. So that going forward, this, unlike in 08, this is not, this is a healthcare driven recession, not a, economic bubble burst. So it's a little bit harder to predict, and they're being very careful about limiting even when they do give the exceptions.
And before we move on, Dave, to your portion, I'd just maybe put a little footnote in here about, for some, the election cycle has also weighed into the calculus as well. Depending on what you envision in terms of which party takes office and the tax consequences of that and the legislation that will follow, there are some, I think, probably more in that owner-founder bucket that are looking at, okay, well, and I don't think it's necessarily just a do I start a process or not, but more around timing of when and if I'm in the game and how quickly I try to get to a close to head some of that off. So with that, Dave, I'll turn it back over to you and let you take the ball from here.
All right. Thanks, Sam. Thanks, Jeff. So returning then to some questions we had for Brett and wanted to get his take on a number of these things. The first one is really in the early days of COVID, and we don't want to talk too much history here, so there's a reason to go back, but you could kind of share your perspective, Prospect Partners' perspective maybe on how do you react, how did you react in the early days? You've got a portfolio of companies, they're all middle market companies in different industries and some kind of unique niches, right?
Yep.
Is there a common thread to the approach you took then? What happened to deal making? Was it all triaging the portfolio? How did you react? And then if you could describe kind of how that's shifting now, call it 6 months in.
Sure. No, that's a great question. And just to give a little sense of context, Prospect Partners is lower mid-market, or what we call pre-mid-market private equity. So most of the companies we're dealing with are sub 100 million of revenue, anywhere in that 25 to 100 million of revenue. We're generalists, so we're kind of industry agnostic out there, and we really think of ourselves as speaking fluent entrepreneurs. So we're working only with entrepreneurial businesses. We're not buying from other private equity firms. We're not dealing with kind of big teams out there. We're working with the entrepreneurs and the businesses they have built. And you're right, we've got a portfolio of 13 companies today, Dave, and those early innings, and it will tie into what Jeff and Dan were talking about, so it's worth rehashing a second. I mean, the early innings was a lot of triaging. It was a lot of time getting our teams on the same page. I mean, let's face it, our teams are spread across the country. They're in different industries. Dare I say they have different political affiliations. There was just a lot of differences amongst those groups that took a while to get everybody on the same page. Once we were on the same page, cash is king. And so the focus on cash flow and liquidity became topic, kind of 1, 2, and 3 day in and day out. And I think, there are certain tools you put in place, whether it's the 13-week cash flows, whether it's, kind of monitoring cash inflows, cash outflows, a lot of kind of hands-on, roll up your sleeve tactical work that we were doing in the early innings, and really focused on communication. And I would tell you, there's a couple lessons coming out of this so far. I think Jeff's right. Who knows whether it's, whether there's another wave of this, but you got to over communicate with your employees and your lenders. I think that was kind of a key lesson coming out of this. Both constituents are incredibly important in our world, and you got to make sure you've got the messaging right with those folks. I think it also pays to have deep relationships with your lenders out there. Again, this was our view. We tend to take a more relationship-oriented approach to financing, so we weren't chasing the last quarter turn of leverage out there in 2019, 2018. Important for us to find folks that we knew and trusted. And I think those relationships come into play during a situation like this. Also really important to focus on your AR as part of this, right? For the business owners out there, they know this world, but when somebody is at home and working from home, magically, it's a lot longer for your AR to roll in than it was before, and you still got paychecks that need to go out the door. So, yeah, I think there were a few, kind of very tactical things that we did to respond and kind of overemphasized in certain areas out there. But I'll tell you, as things have shifted in the last couple months, we're really focused right now is just truthfully on the mental strain for folks out there. I think people are tired right now. I'll tell you, across our portfolio, I think there's a level of exhaustion that's set in. We're now 6 months into this. I think to Jeff's point, we got a sense of where 2020 is going, knock on wood. We have no great idea where 2021 is heading, and I think that level of uncertainty is difficult for some folks out there right now. And then you've got a lot of personal dynamics at play. You've got kids you're worried about. You've got parents you're worried about. All that stuff is kind of coming to play right now for business owners, for our management teams, for us. And we've been kind of working hard over the last few months on how you kind of manage through those different elements. So we're kind of out of the triage mode. There's a sense of stability, but also a sense of exhaustion that I think our teams are kind of working through with their employees. And, the human element shouldn't be kind of undersold in this whole dynamic here. It's easy to sit back and talk about transactions and buying and selling, but, there is that level of exhaustion that I think is setting in for a lot of folks out there.
I think that's a great point. People talk so much in the deal community about how much dry powder there is. I think just figures that Jeff offered that, and these could be larger deals, small deals, whatever. But with $3 trillion perhaps on the sidelines, and for big deals, $1 trillion in dry powder in private equity, if you believe that number. It's hard to know exactly how we get to that number, but seems about right. Why aren't more deals getting done? Right? There are in some areas. Other areas are still saying, hey, we're kind of slow. Those companies are sort of not in the top of their game or top tier, right? I think the human element is a lot of it. The deals where you've got to roll up your sleeves and deal with something that's messy and takes a lot of thought and work to get it structured properly. Some people, I think, are still saying, I just got through 6 months of COVID, right? Not sure I'm ready to do that.
Yeah, I mean, these processes, as we all know, these processes are exhausting to begin with, right? I mean, when you're dealing with a private equity firm or an institutional buyer, whether it's strategic or private equity, they take time, they take effort. Folks have a day job. They've also now got a night job, which is managing COVID, and now you're asking them to put a transaction on the top of it. And some bigger companies can handle that, and that's fantastic. I think for a lot of entrepreneurs, that's a hard thing to contemplate at the current moment. And I think it gets a little bit to what Jeff was talking about earlier. Processes to handle that and to cope with it, processes are taking longer. And I think early on in the conversations we were having with our investment banking friends out there, at first it was the shock of like, wow, everything is on hold. We've never seen this before. Then it was, hey, we've got a restructuring group. Let us know if you need any restructuring help out there. Yeah. Now we've kind of moved into, we're back in the market. We want to dip our toes in the water. But we also recognize it may not be the right time to do a 200-person auction out there, that it may be time to do a more limited auction and set valuation to the side. I don't think it's really about valuation. I think it's back to, does a company have the bandwidth to manage a 200-person auction at the current moment? And in a lot of cases, I think the answer is no, that, they can get just as good of a price running a more limited process out there and hopefully maintain some of the mental energy to deal with the day job.
Mm-hmm. So 6 months in, if you could say, is there one or two big changes in sort of how you evaluate a deal? I mean, is there anything that you do differently? The financial modeling probably looks similar except for all these COVID X factors, but how do you approach a deal differently, if at all?
Yeah, no, that's great. It's a great question. I think by and large, you're approaching deals similar to where you were before. I don't know that there's, massive changes in how you're approaching the deal. You're always trying to look out there and see where the company's heading. We just spent the last 2 years worrying about, is a company recession-proof? Is a company recession-proof? We've talked about that ad nauseum. We quickly found out 6 months ago that recession-proof and pandemic-proof are two totally different concepts, right? So all that worrying about recession-proof, mattered, but maybe not to the degree in which we hoped it did. So, you're always thinking about that stuff. I think the element of flexibility is a big one today, and that's both in deal structure, as Jeff mentioned, as well as in timing. And I think we all have gotten used to rolling with the punches, and I think a sale process is no different, right? I mean, we had a deal that we were out there, we wanted to bring some service providers on site to do some work, and the service provider was reluctant, not because they were worried about their employee getting sick, but they were worried that they would get somebody at the company sick, and that deal would crater, right? So there's a lot of these sorts of dynamics that you may not at first blush seem obvious, that you kind of got to be flexible and work your way through. On deal structures, and I'll be the first to say I hate earnouts, but they are becoming a lot more prevalent. Jeff and Sam are absolutely right that they're out there. I think they can be a useful tool. I think that they will be the legal gift that keeps on giving in 12 or 24 months to get, negotiated again. But there's no doubt that, that is one way to try to bridge the difference. And we're seeing that. Seller notes of various forms and fashions are out there, kind of senior preferred equity and how that's managed in the capital structure is out there. So, there are plenty of tools that you can use to try to structure around, but, flexibility is kind of first and foremost, both in process and in structure.
It makes sense. It seems like to your last point on earnouts and related, it seems like after the 2008 to whenever it ended recession, we spent a lot of time saying, well, earnouts are here to stay, right? Earnouts are here to stay. And then maybe we got comfortable that they weren't so necessary. There's still an element of a lot of deals over the last few years, but people started to maybe be more reasonable, at least in some deals, on exactly how they'd be structured. And then here we are with people saying, put your money where your mouth is. We have a deal pending currently that actually has a royalty component. So you're not looking at filtering things down through the earnout, to the bottom line or some other metric, and you're actually taking something off the top based solely on revenue, which is a little scary if you think about it. But yeah, people are definitely starting to push the envelope on creativity here, aren't they?
I'd add to that though. The reaction, obviously, seller notes, earnouts, they're always going to be subordinated to, assuming it's a finance transaction. And I have seen a few happening in the last couple of months, and I will say the reaction of the lenders, which in a normal environment those are going to be deeply subordinated, is extra deeply subordinated now. So I always just kind of preface when I'm working with a seller that, when you go in and you take a seller note particularly, I think earnouts are a little bit easier to work around. But when you're taking a seller note, it's maybe slightly above that preferred equity,
right?
Rung of the capital stack. But be clear that you're not going to be able to enforce that note so long as any senior lender's around. And I think people throw around the term, it'll be subordinated, without really digging into what that actually will look like when you get a seller note subordination agreement to you handed to you, 3 days before closing.
Yep.
So I digress a little bit there.
No, it's right. I mean, the quality of the seller note. I've heard the term hope note a lot more lately, and it's like a term I feel like is sort of out of favor. And I've heard it on deals where you wouldn't normally call it that, but that's beginning to be.
In my opinion, if you can do it in the form of an earnout, it's going to be easier to justify getting the money out than if you're just doing straight deferred purchase price through a seller note. But I wouldn't say that's universally true.
Right. Yeah. I think the other thing I'd add is we're spending a lot of time right now, both on new deals and existing portfolio companies, trying to work our way as far up the sales funnel as we can. It's a little bit to Dan's point about getting information for the lenders, but it's also for ourselves. So to pick an extreme example, if a lender used to be comfortable with, here's what, financials from 30 days ago or 60 days ago, that doesn't really fly today, and it doesn't really fly for us either. We're trying to work our way not only to, kind of where were order volumes last week, but in some cases, we're working our way up that sales funnel. We have one of our companies that's tracking daily call volumes, right? And how long are those calls going? Are the calls shorter or longer than they were pre-COVID, right? And so you're just trying to get as far of a look up that sales funnel as you can to say, listen, the future looks okay, the future looks good, or the future looks bad. I don't know that anybody can, with a lot of, outside of some of our kind of recurring revenue SaaS businesses that we don't own any, but outside of those sorts of dynamics, I think it's really hard to really look out there and say, here's where 2021 is. So you're just trying to peek around the corner as best you can right now and using whatever tools you can do. You have to do that.
Sure. Well, and I would add briefly that in those recurring revenue SaaS businesses, great point that even those are seeing, you can't quite trust the recurring revenue nature of any of these things, right? You look at it, you used to do deals based on, in part, annualized contract value and metrics like that are important to those businesses. And none of it means anything if your customer is going out of business, your customer is gonna pretend that you're not essential, or they're gonna put you behind their landlord for payments, right? So that is, we are seeing a lot of people getting much more careful with how they analyze those kinds of businesses as well. So a couple more minutes before we move on to some other topics, but anything you could say in the way your exit outlook has changed? We talked about your process in evaluating a deal. How do you think about, hey, what's an exit look like?
Yeah, I think it's really deal specific. It's really industry specific at this point. I mean, as a whole, I would say, probably push some of our exits back from where you thought they'd be. But, I don't know that that's a universal statement. I think certainly, as it relates to overall deal velocity out there, if you can prove that you've kind of withstood this pandemic, I would argue kind of from a valuation and outlook perspective, you should be going sooner rather than later. There's a dearth of really good businesses that have proven they can kind of withstand this and God forbid, grow through this. And that's a great spot to be in. I think that if you've taken kind of your normal course, and what I would call normal course is, you're kind of trying to hold par with last year, maybe down from budget, but, kind of trying to hold where you were last year, plus or minus. You probably haven't, really impacted your exit outlook. And then I think there's the obvious, which, you're in the restaurant, hospitality, aerospace industries, in which case, you're looking for a really delayed exit out there. I think the outlook will be good longer term for some of those, but you're trying to get through the valley right now and not at all focused on the exit timelines.
All right. So let me ask you one other question. If you were sitting across the table from an entrepreneur or a middle market company looking to maybe sell, anything that you think they should do, and maybe I'm asking you to play investment banker here or a lawyer for a minute, so sorry, but you've been around a few of us, right? What are the things they need to do, and is there anything different than sort of pre-COVID that you would want that company to have done before it gets a hard look from the outside?
Yeah, as Jeff and John, some of the guys can tell you out there. I mean, the whole idea of kind of sell side QOV and kind of getting your financial house in order had already become the norm, kind of through 2019. I think that's really only become more emphasized right now during COVID. I mean, if you're truly thinking about exiting, you really got to make sure you're thinking through, how did COVID impact you? How can you bracket that as best you can? What's your outlook for the coming year? And then do you have a management team that's excited to be pushing forward out there? And that's really for us a big piece of it, which is, kind of where's management's head at? It's going to be a long process to get through the deal. And then you've got a lot of years ahead of you, with a lot of uncertainty. Are you really excited about this at the current moment? So I think you got to really look in the mirror and make sure you're committed to the process. You got your house in order and you're ready to go. In which case, I think, you're probably in decent shape out there.
Makes sense. I mean, we're given similar advice that, if the company was going to be a tough one to sell pre-COVID, like this is not the time to test the mettle of or the resolve or the risk tolerance of potential buyers, right? You have an opportunity to get some things in order, and these quarters this year might be something you can kind of explain away if getting the house in order meant making changes that would otherwise kind of look funny in the financials, right?
Yep.
It's a good time to clean it up if you're in that sort of lower tier in terms of attractiveness to buyers. You've got some time to work with here. It isn't all about get it done right now, but obviously if our business is positioned well, there's plenty of opportunity to exit. Deanne and John, wanted to turn it to you and take us through some things that are on the mind of,
Yeah, for sure. Again, thanks everyone for joining. My name's Dan Stralk. I'm a partner in the Global Finance Group here. I work primarily on financing transactions, representing a healthy mix of lenders, all types of lenders, banks, private debt funds, et cetera, and borrowers, both sponsor-led deals and sort of just, closely held family businesses with working capital lines of credit, things like that. So I'm used to working with lenders that, have strict credit criteria, and they're kind of by the book. So it was a pleasure preparing for this presentation to work with John, who has somewhat of a different role at BMO. He's in their corporate advisory group, and his focus is is not that of a lender, but more of maximizing value for corporate clients at BMO. And I'll let John explain so he can do it better justice than I. So John, why don't you tell everyone about your role in your group?
Well, excellent. Thanks for the opportunity. Every time we do one of these, I have to take a moment to kind of explain, because what we do is a little bit unusual, and most people are not familiar with a bank that does the sort of things that we do. So my role really starts and stops with value creation for owners and management. And so we spend all of our time sitting with our clients and our prospects talking about how do you grow this business, or how do you realize the value of the equity that you have accumulated in your business without necessarily selling it. Well, of course, the sale is always on the table, and we would always entertain that, and that becomes the baseline by which we compare everything else against. That said, our goal first and foremost is growth. It's value creation, and if someone is at the point where they want to transition their business to another ownership structure, helping them understand what their options are, what does that deal look like, and ultimately helping to facilitate that through a lending relationship with our organization.
Yeah. So how has that role, I imagine that's changed quite a bit giving effect to the COVID environment. Can you give some examples of how you sort of started to look at these differently?
Well, sure. Yeah, no, it's funny because I think every time something like this happens, there's a sort of rush to make yourself relevant. And we went through that just as everybody else did. And Brett, you brought up something earlier, which I thought was really interesting, which is the 13-week cash flow forecast. And so we spend our time doing buy-side M&A. We spend our time doing ownership transition. We help our companies transition to ESOPs if that's what they want to do, or sell to the management team or their children. Well, all of that came to a screeching halt, as we know, 6 months ago, and everybody was in wait-and-see mode. And so one of the things we can do is pivot what we do and the way that we help our clients. And one of the things that we did is develop a 13-week cash flow forecasting tool. And the goal was really to help our clients implement that. And it's something that, and you see it oftentimes with private equity funds. So it's not, I don't think, uncommon for Brett to have brought that up. And I imagine that they have implemented that at a lot of their clients. But we have found that it really benefits everyone who does one. And once one of these is done and implemented, we find that even when things turn back to a normal time period, a lot of clients continue to roll it forward. It's not terribly time intensive if you do it the right way. And it can lend you an incredible viewpoint into your own business, the way it functions, the way that you're converting your sales into cash, and making very granular decisions that become ultimately, on the whole, very strategic. And doing that every single week, having a weekly check-in with your accounts payable and your accounts receivable teams to make sure that you're managing cash in your business. And we find that companies see a ton of value in it and roll it forward.
How does a company take that on as an undertaking? They don't have one now. They heard you speak and they think it's a good idea. Do they call you or do they
call me? Yeah, well, yeah. I mean, you can do it yourself. It's more intuitive than you might think, and of course, it helps to have somebody who's done it a number of times to sit down and help you walk through it. Because even how does one look? What line items do you have? How do you roll it forward? How do you reconcile it against expectations? So having someone who's done it before is generally, the way to go and is very helpful. But, this gets back to when your business was in its infancy, how did you do things? You probably had cash accounting. You basically ran your company out of a shoebox. And the way that you do that is by deciding what bills to pay, depending on how much money is in your bank account. And some of this comes back to that. It's a very simplistic way to look at a business. What are your sales? How quickly do you convert them to cash? And then when you have the cash, who do you pay with that cash? You have employees, you have rent, you have to buy materials, you have to have a production schedule, you have to pay for your payables. And ultimately, these are the types of tools that you have at your fingertips. And so then the question is, how do you finance all of this working capital? And is there, when we're looking at our borrowing base or we're looking at our revolver, and we're pulling money down off of a revolver to continue to fund, potential shortfalls or even to add leverage to a business that frankly needs it. It just helps you to see your business from a different viewpoint.
Absolutely. And actually just this morning, I received a phone call from a private equity group that has a healthy business, and they're debating whether they approach lenders about a dividend recap or a sale, and I know you and I touched base a little bit about that. I know that's out there as in normal times an attractive option. If people aren't ready to, a company's not ready to sell, or what are your thoughts on dividend recaps in the marketplace right now, or lack thereof, and what it would take to get one of those done? I know you've been successful in doing at least one that we talked about, but any thoughts on that?
Yeah, they're not terribly popular with banks right now, but yeah, I was on the phone actually yesterday with a client that's looking at doing a dividend recap, and that's something that we have proposed on and we're planning to close around. And so they're not terribly common as much as they were certainly a year ago. But they can be done. They can still get done with the right type of client, the right type of profile. This particular company is doing pretty well during the COVID era. They've been around within our organization for a while. That's also helpful. Your lender's got to have some familiarity with you, has to have a comfort level with you, and it certainly helps to have a good performance track record through the pandemic period.
I think that goes back to what everyone was kind of saying about the power of information right now, and the power of tracking sort of how your company has performed, through the environment before and the projections going forward, and that 13-week cash flow could be extremely helpful with that, in my opinion. I wanted to save time for questions, but I wanted to talk about PPP loans a little bit, because I think it kind of came up when all of us were talking in one way or another. And now we're starting getting to the point where the PPP loans are out there. Maybe the money's all been used or not quite. It's sort of running out. So there's liquidity issues. There's this existing PPP loan that has certain conditions on it. Why don't you give your thoughts on how that's affecting the marketplace, some of the unique challenges it brings to a deal, or to some of the other strategies that you're trying to implement for your customers?
Yeah, and we were all talking about this before, but PPP is really kind of the topic du jour, it seems, especially in the M&A markets, because it's getting in the way. It's really has created this is going to come off a little funny, but it's kind of created a lack of liquidity in the marketplace, and not from a lending perspective, not from a access to capital perspective, but just in terms of the actual marketplace itself, being able to actually get trades done, put a buyer and a seller together, because, of course, as we know, this is this issue is cropping up around forgiveness or forgivability. What we have seen is a handful of different approaches. We've seen companies actually just pay it off to eliminate that as a problem in the deal structure. And of course, this all depends on relative size. I mean, if you're looking at a very, very large deal and the PPP loan happened to be fairly small, maybe this isn't worth doing, especially in light of something else that came up, which was potential changes to the tax code and tax rates. Which and this is interesting. This same deal that I was talking about before that was doing the dividend recap. This is a company that is looking to pull every single dollar that they can out of their business today, even insofar as they will cash collateralize an account and pledge it against a loan, because they want to lock in their tax rate today or this year. Because if you step back and you think about it, and you look at if you, for example, have a pass-through entity, and you could conceivably see your capital gains rate double. This is alarming for a lot of people. So a lot of people are doing everything they can to kind of pull their capital out now. And so when it comes to a PPP loan, let's say you've got a $2 million PPP loan in your business, that's a relatively small price to pay as compared to rolling the dice on a massive increase in your capital gains rate. And so this is something that we've seen a lot of clients really focus in on as well, not surprisingly. But there are some different approaches, and of course, I think everybody here has seen different things. I'd love to hear what everyone else has to say about this as well. We've seen companies set up escrow accounts that are pending forgiveness. We've seen the emergence of insurance products as well. Also something to think about. I've never actually seen one get done, but it's brand new. So who knows how that will come into
just
play.
Like the record warranty insurance.
Just like record warranty, which is now the standard, right?
Now it's standard, right?
But, but you look at with my conversations internally with our folks that have spent all their time on PPP essentially since April. What I'm hearing from them is there's no way we get clarity on really any forgiveness this calendar year. We're looking into potentially, February of next year before we're getting any meaningful clarity on forgiveness. So it's really going to create a problem for people who are facing this decision of, do I wait to see if I get forgiveness, then run a process, but risk higher tax rates, or do I just sell now and deal with the PPP as part of the negotiation on the sale?
Yeah.
And I think we've gone through a couple here recently. I think in both situations, we've seen escrows be the preferred method for handling those. I also think it is adding some lead time. Most of the banks will require a waiver or on change of control if you have a PPP loan outstanding, but you don't want to go to them at the last minute and ask for that waiver. So, kind of factor that lead time in. But I also think, and listen, I'm probably the least qualified given all the attorneys on this call to make this comment, but I would say, be very careful as it relates to kind of capital structure planning while you have a PPP loan outstanding. I don't know that the government will look fondly on a big dividend recap, while you've got a PPP loan outstanding and you've been claiming necessity for PPP loans. So I think there is some thoughtfulness you have to apply, while you have the government looking over your shoulder and that loan is outstanding. And I think most folks are taking that into account during transactions as well, saying the forgiveness aspect is uncertain, escrow the money, and let's hope it all clears up and we can all go our own way.
Yeah, one comment on that, which I think is interesting, which is certainly the government would not look fondly upon people owners taking capital out of their business while they're owed the taxpayers potential money. One thing that could be done is a conversion of equity into a note, which can lock in the sale price on that equity. So you can achieve the locking in your tax rate now, but leave the actual payment to the owners until down the road when things clear up.
Yep.
Yeah, and I'd layer in just one thought on top of Brett's in terms of depending on who the buyer is, right? And if you're in a world where you have an owner-founder deal selling to a PE firm, all that, even if you meet the requirements, which are unclear still, a number of them, that optical piece, whenever you're dealing with the government, and I've had many conversations with clients about this, just they'll ask me, well, am I eligible, right? And you're like, well, let me start with how are you owned, and who owns you? What's your access to capital? Are you Shake Shack? And you meet, but careful what those optics look like. Or are you mom and pop? In which case, you look a little differently to someone coming in to audit you. So that sort of buyer profile and how that's going to play out in sort of that post-audit process is, I think, another factor that's definitely entered in the equation. Sorry, Dan, I think I cut you off.
No problem. Dave, I want to leave. I know we have a couple of questions that people had submitted, so I want to make sure we leave some time. But so I'll turn it back to you.
Sure. No, thanks, Dan, and thanks all. There are a lot of good questions that we've received. We definitely can't address all of these, so I'm going to pick a few that I think are susceptible to relatively quick answers, and obviously contact information for anyone on the panels available is needed. You can request it through the chat or anywhere else. But one of these I thought was a good one is a brief answer to how are deals getting done without face-to-face meetings between buyers and sellers. And I know it'd be really easy to give that sort of flippant, well, you just use Zoom or WebEx or whatever answer, but anybody want to give a short, pithy answer to how you're getting deals done without in-person meetings? Or is that a fallacy? Are you having in-person meetings, just not as many?
I'll jump in there real quickly on some of the processes that we've been working on, and actually one that I was working on through the lockdown. I think it seemed to highlight that in-person meetings are still very important. I think it's hard to expect a private equity investor or a lender to eventually write a check into a deal that they haven't interfaced with management on, or they haven't gotten to really know that company. However, there are other meetings really on some of more the diligence provider side that could be shifted to remote. And so we've actually seen a little bit of a hybrid where those important meetings where buyer and seller are developing a relationship, and that's critical to that deal moving forward, finding a way to accommodate that, however that may be for the parties involved, while being mindful that some of the other work that was once getting done on site can now be handled remotely. And so I think there's a little bit of a hybrid model that we've seen.
Yeah, I'd agree. I'd also add, I think the M&A community, the finance community, and frankly, just everyone in the business community has done a really remarkable job of adjusting and trying to keep things moving as close to normal as they can with the limitations that a pandemic brings. So I would agree though. I'm doing a deal right now. It's a mezz deal, and I was just speaking with the lender on it, and they were out speaking with management. They met outside and did do a few meetings because they didn't like the idea of investing in a company where they hadn't had a face-to-face discussions with the management team.
I think those are all good answers. Certainly there's some due diligence that can be moved virtual. There's some that can't, right? If someone's doing an environmental, a phase one assessment on a property, an industrial site, right? There's no such thing as fully virtualizing it, but there are creative solutions like visiting off hours, obviously all kinds of PPE and other best practices for making it safer. I think personally there are there are a number of in-person meetings happening when they have to. For example, we helped a client with a transaction close about a month ago, and there was a final, let's get everybody in one place to close, which, who does that, right? I thought everything was virtual, even pre-COVID for closings. But there was a human element there. People wanted to be together, and they actually arranged a meeting in a parking garage. Can you believe that? I'm not kidding, a parking garage. Right? Funny breeze. And then you had some people who couldn't be there in person, so they had video carts with a couple monitors. It was bizarre, but people are meeting in person, I think, if that's the thing keeping a deal from getting done, and if it's physically possible, it doesn't involve a 3,000-mile drive or flying to some country where they're going to turn you away because the border's closed. People are meeting in person, I think, when they need to. I've not seen that stop a deal that would otherwise get done. But okay, just going to a couple of other questions here. How about the interest rate question. If interest rates will be this low for a number of years, how do you see this affecting deals from the buyer and seller side? You probably write a book about that, but who wants to take buyer's side?
I'll take buyer's side. I mean, the interest rates have been low for a while now. I think we've kind of priced that in. Multiples have been high for a while now. I don't know that what's going on right now with interest rates are necessarily going to change, the ultimate outcome. I think that's kind of long been factored in to decision making by and large. I do think the availability of capital is real. I think that it's going to remain out there for good businesses. Capital needs to be put to work. Buyers are going to be willing. And I think right now the lending markets, from what we've seen, have come back. Maybe they're a quarter to a half a turn lower than they were before. Pricing is 50 basis points to 100 basis points higher than it was before. And those are kind of just general terms. But by and large, I think the capital's there on the lending and the equity side. I think the interest rates have been factored in, and I think valuations probably aren't going to meaningfully change. Again, I think it's more the structure that's changing than the overall valuations that are changing at the current moment.
Makes sense. How about anybody from the seller perspective here?
I think that's a good point. Yeah, I would just weigh in that we get that question as well from clients as to whether or not low interest rates enables a buyer to elevate up the purchase price that they are willing to propose on a deal. And I think Brett's point is spot on in that we've been living in an environment with persistently low interest rates. And so to some extent, that's already been factored into the valuations. I think the one benefit maybe that we have is that sitting here today, we do have some visibility that interest rates will probably remain low. So I think that enables that current mindset to extend out into the future.
Yep.
Makes sense. Another question we have here is how many of the deals that the panelists are talking about had commenced diligence prior to COVID versus deals that were really kind of originated or kicked off during COVID? And if I could offer a little observation there, I think that the deals you saw closing in May, obviously, most of these, at least in my experience, I think our firm's experience were deals where, of course, diligence had kicked off, in the winter, let's say, and that really everybody slammed the brakes on, say, third week of March. And then people said, well, we can do this. We can get it done, right? So that I feel like those were sort of the Q2 closings. Other perspectives on that? I mean, now I seem to be well into deals that are, completely originated during COVID. Any other perspectives?
Three that come to mind in my practice. One that literally tanked the day before the shelter-in-place order was issued here in Illinois, and they kind of saw that coming. But that was inline retail, so that was particularly a vulnerable industry. And then I've seen one deal that it's a larger deal, and that started prior to the COVID disruption, and that is still on track to close and probably will be closing in the next few weeks here. And then I've only seen one that started fresh after the disruption and looks to be right on track to close. But that's just three that come to mind in my practice.
I think it's early innings to see deals that have closed kind of that truly originated post-COVID. Right. If you think about it, most folks want to see how did you perform in Q2, which kind of takes you into July till you know that. And now you're in mid-September. So you're talking kind of 60 days from when you saw Q2 numbers, which again, in this era is probably a little bit quick. Yeah. Not for the big deals, but for the mid-market deals. So I would expect in the next 30 days, you'd probably start seeing more of those that kind of originated and showed their, their performance here post.
Agreed. And on the leveraged acquisitions, in that mid-market space, the lenders really were for a while there. All they were doing were getting these PPP loans out, and I mean it was a real draw on human resources that no one was going out there underwriting new deals. Even if they were interested, they were just saying, we're not looking at anything right now, and they're pushing. But now I'm starting to see, it normalize a bit.
Great.
Makes sense. Well, thanks, everybody. That hour flew by. We're already at 3:01 Central here. So I'd like to say thank you to everyone for participating. Thank you to our guests. As I mentioned earlier, guests are certainly able to submit something into the chat. We'll have our team keep an eye on that. And if you're looking for contact information or have questions, I'm sure our panelists will be happy to connect with you in an offline format. So thanks again, everybody. And we appreciate you making time for our program.
Thank you.
Thanks all.
Thank you very much.